Recording.
So there were 3 votes.
Okay, happy midday to everyone. I'd like to extend a thank you out to the Cincinnati Area Board of Realtors and the Realtor Lender Committee for today's construction lending update, process, and information piece. I am Chris Cooper, the current Vice Chair on the Realtor Lender Committee here at Area Board. And joining us today as a presenter will be a very honored, critically acclaimed loan officer that I've had the privilege of working with, also as a member of our committee, freshly member of our committee, Phil Forbes with Tallmer Bank and Trust. And without any more delay, I'd like to allow Phil to take over from this point. Thank you.
Good afternoon, folks. I'm Phil Forbes with Tallmer Bank and Trust, and I'm here today not to simply talk about Tallmer Bank and Trust products, but to really introduce everyone to the concept of construction lending and share some thoughts and ideas on it, and kind of get you guys tuned into where that fits in the marketplace and what that process looks like from a practical perspective. Feel free to ask questions via the options. You can type your questions in. We will see them. I think for the most part we're going to be holding questions to the end, but we will definitely get to your questions. So as you're thinking of them, feel free to sign them in and we'll deal with them. Another little plug that I would like to give, there's a whole series of these webinars online that you guys can back up and check the links out to, and it's really good information. The more informed you are of these topics, the more productive you're going to be as a realtor, and the more opportunities you're really going to be able to see for your clients. And that's really what we're all about here, is helping our clients recognize all the opportunities in front of them to help them maximize their opportunities and help homeownership grow in Greater Cincinnati and really throughout the country. So anyway, without further ado, we're going to move on to the very first page, or the very first slide in our presentation today. And that slide is, having a little trouble moving it here. Why new construction is important. New construction, as we all have heard lately, has taken a massive hit in the last 5 years. And that's actually a very, very disturbing statistic. New construction is really the bedrock of our housing market. And if we stopped building new homes, taking that out 100 years from now, we would all virtually be back to living in huts. So, I mean, at some point you really have to replace the housing stock that's aging and depreciating out. The new home of today is going to be 80 years old 80 years from now, and at some point those homes are going to need to be torn down, replaced, rebuilt, updated to a current style of living, and that sort of thing happens on a daily basis. We need to worry about that a little bit. We need to make sure that there are homes available for the market as things come up. I think many of us are already seeing some slight issues with lack of inventory in the market. And again, this replacement of housing stock really speaks to that. We want to make sure that we have plenty of inventory going on in our market. So that is done through the development of new real estate. So we need to do that. The other thing that causes our housing stock to effectively decrease is the fact that the population continues to grow. We as a species continue to have babies, and as a result of that, we need places to live. And as those babies grow up into adults, they become members of the community and productive members of society. They need homes for their children. So the other thing that's really, really critical and why new construction is helping us is to, basically keep housing stock becoming available for a growing population. Again, through the recession that we saw since 2008, we saw a reduction in the number of new households being formed, and that reduction is beginning to lighten up, and we're beginning to see new households forming again. Again, creating a marketplace for new housing stock. Finally, the reason we need to keep new construction moving along is because it creates interest and excitement in the market. There are people in the world who probably aren't all that interested in buying another house that's sitting there in front of them on the market, but they would be interested in building something specific to their tastes. So at some point, people may reach the point that they have the money and the time to focus on developing a space to live in that exactly matches their wants and their lifestyles. And without new construction, that's going to be impossible. So without further ado, we're going to move on to our next topic, when construction loans come into play. A lot of the new housing stock that comes out, I'm sure everyone's available or is aware, is available through, major builders, the Drees, the Miranda Homes. And those are builders that can produce a large number of homes. And generally speaking, don't use construction financing like we're talking about today. The construction loans that we're talking about today are loans that finance the construction of a home for a specific buyer. These loans are often done for kind of large-scale custom homes. Is really a typical buyer for these. These are often done by smaller custom builders, and those custom builders may not have the ability to build, 20, 30 homes a year and finance the construction of those individual homes while they're in process. They may be only able to carry one or two or less homes at a time. So what these construction loans do is they allow a buyer to either bring their own lot to the table as collateral, or to finance along with the construction of the home, the purchase of a lot, and it allows them to work with a builder to build the home of their taste, and that builder to move forward with comfort and the knowledge that they're going to get paid.
So you mentioned bringing a lot as collateral from an owner who owns the lot. Now, would that lot have to be owned without a mortgage for SPAY? They'd have to own it free and clear?
No, not at all. The lot can be, you can have a mortgage on that lot. So, we've seen at our bank certainly situations where people finance the purchase of that lot. We've seen situations where the lots were gifted by a family member, maybe cut off of a piece of family land. We've seen a lot of different sources on that. But mortgage or not, whether they own it or not, or whether they want to finance the purchase of that lot into the construction of the home, it really doesn't matter. Construction loan's a construction loan. Different lenders may look at that policy differently, but in general, as a rule, it's pretty easy to find a lender that's going to handle someone who either needs to roll that purchase in or is treating that as if it's a refinance and already owns the property that they're building on.
Awesome.
Thanks. Great point. Thanks, Chris. The other advantage of a construction loan is you can do a major build through a construction loan. And what I mean by that is, some projects, will range in price tag anywhere from $300 up to a few $1 million. And if you want to build a $4 million home, a construction loan will allow for that. A lot of builders aren't going to be able to take on the liability and the risk that they build that for a client and then get paid at the very, very end of construction. Those can be, year-long construction projects with millions of dollars laid out prior to the closing, or prior to the completion of the property, rather. And so construction financing can again be important for situations like that where we need a large build to progress. Moving on to the next slide in our presentation, how that process is going to look to the buyer. For the buyer, the construction loan is very, very similar to the standard loan process, with a couple of steps kind of interspersed inside of the process. It's really the purchase process that looks most different to the buyer. most of the people considering a construction loan, I would absolutely recommend that they get pre-approved. A little later in this discussion, we'll talk about some of the underwriting criteria associated with construction loans, but generally a construction loan is going to call for a slightly higher level of buyer.
When you talk about pre-approval, Phil, is there a rule or a restriction on, or basically, are they getting pre-approved for the house build and the land together? It's saying they're financing it together, and during the approval process, or is there a restriction for how much land can be a part of the loan? For example, they're building a small home on 100 acres of land.
Well, that can always be an issue with any loan, and so that's why we absolutely encourage the pre-approval, because especially with these construction loans, when you've got a buyer who's looking to really build the home of their dreams to exactly their tastes, they certainly want to talk to a professional about what's allowable. Anytime that the majority of the value is going to sit in the land, you're really more talking about a land loan than you are a home loan. And those have different standards, and chances are you're even going to talk to a completely different type of lender. Your garden variety residential mortgage lender is probably not your best choice for that option. There are some good choices in the marketplace for that option. But usually I would discourage my buyers from that purchase. But that's very much part of the discussion, and there's a sliding scale to that. Sometimes there's bad information in the world that will say, well, beyond 5 acres can't be financed in a standard loan, or beyond 10 acres can't be financed, or 25 acres. And you'll hear some different numbers thrown out there. But the reality of it is, it's a little bit to lender discretion, number one, and it's very much dependent on the marketplace. If every home selling in the market is 14 acres, then 14 acres is going to be acceptable. And if there's reasonable comps to, a home with, 14 acres, or really maybe better said, something in the range of 10 to 15 acres, if there's other homes like that selling in the market, it's going to be completely acceptable with most lenders. But again, it's very situational, and this is why we encourage the pre-approval.
So this pre-approval meeting, when you're talking about our client, a buyer, wants to work with us to hire them to find a piece of land and use you or any other bank to finance the perm loan, how should the pre-approval process start? Where they sit down with all three of us together and discuss, okay, you've got to look at how much land you're looking for the area, right, as we just discussed.
Sure.
And then, of course, you pull all the regular information that you would as if they were buying a resale?
Similar to that, yeah. From the realtor's perspective, yeah, you definitely want to pull similar information as if they're buying a resale. And, a great example to that is by the time they buy the land and they build the home, it's going to cost them $500,000. And, they can find a very, very similar home currently on the market for $400,000. There's a lot of problems that just exposed, and we want to know about that sort of thing early. Generally speaking, we don't do a meeting among the three of us, but usually there's a lot of communication. Most pre-approvals with us anyway, and I think most lenders handle it this way, is going to start with a detailed phone call. And those phone calls run anywhere from 20 minutes to an hour, just kind of talking about what their goals are and what they need to understand about the program. Often they'll follow with some sort of loan application, whether that's done during that pre-approval call or online, so that we can get credit looked at. The loan officer should certainly request and receive income documentation, asset documentation to make sure that we're dealing with the borrower who, really credit qualifies and income and asset qualifies for the loan. And then also, that discussion will include that construction loan aspect of the discussion of, what type of home do you want to build? Home type can be a major issue. Log homes are a very, very specific animal to finance that can run you into some problems. And if you're going to run into problems like that, you want to hear about them at meeting one, not when you're turning in your plans and specs for the property. So, these certainly can be detailed, and they deserve some extra effort in the pre-approval process. But as long as everything seems basically standard and you've kind of achieved the pre-approval, usually your file, at least from the lender's perspective, is going to go dormant for a while. And what's happening during that lender's period of dormancy is we're just waiting for a complete loan application package so that we've got enough information to really start on the file. During this mode, the buyer and the realtor are going to be extremely busy. This is the time when contracts are written to purchase the land if the land's not already owned. This is time that the buyer is selecting which builder they want to choose to build the home on the property. This is once that's done, or maybe built into that process, the buyer's also going to retain an architect, or one way or another get some sort of plans together for the home that they're going to build. So the buyer during this period between pre-approval and actual loan application is going to be really busy. And in my experience, this is the piece of the process that usually and unexpectedly takes the longest. It is not uncommon for this part of the process to run 2 months. I've seen 3 and 4 months. I think the quickest I've ever seen it was 4 weeks. But from the time someone's pre-approved until they're really ready to make application, which we're going to cover next, there's a lot that goes on, and that's the time that you as the agent are busiest. So from there, from once everybody's achieved a architectural drawings that they're comfortable with, that they want to build, they've selected their builder, that's when they're going to come down and get a final contract with the builder. And that's the builder committing to the price to build the property as they want it built. And notice I say property in there. There's going to be improvements, outside of the home, things like driveways, et cetera, should all be thought of when this is going on. As a lender, we're usually looking for a complete piece of collateral. So saying, we're going to get this done, except we're not going to bother with, landscaping and driveway because we'll get to that later, probably not acceptable. You really want this to be complete. So when we have complete plans and specs, we've got a contract with the builder. That's when the lender usually jumps back into process here, and we start with the loan application. The loan application is going to be very, very dollar specific. And as a result of it being dollar specific, it takes a little bit of time for everyone to, takes a little bit of time. We have to have all these documents, like I said, the plans and specs, contracts, et cetera. Loan program needs to be chosen, whether they're doing it adjustable or fixed, what type of term they're doing, et cetera. But once all that's done, the loan application can be done. The buyer, usually within a day or two of everything being complete, this can be done. The buyer is going to sign off on their loan application, pay an appraisal fee. Depending on the individual lender, may be able to lock their interest rate at that time. Some lenders do not allow for that. And at that point, the loan process really starts. Keep in mind, we're sending an appraiser out. And so that appraisal has to be done according to the plans and specs. We can't appraise a property if we don't know what it's going to be. And so we need to understand specifics about it. We're looking to that contract to build to say things like, granite countertops and 3/4 inch maple hardwood floors. Or to read those plans and specs and see, we've got a laminate countertop and a rolled vinyl floor product. Those are going to be 2 different houses, and they're going to appraise differently. So that's why these contracts being complete with detailed specifications are so important. The builders are usually fairly used to this process. All lenders require things to be complete so that that appraisal can be complete. And then the appraiser is going to go out to the actual lot, photograph the lot, and consider a value for a home built per the plans and specs on that lot that's been specified and arrive at a value. And that's how the appraisal is done. While that's happening, loan approval is going to be in process. That's the underwriter's job that takes the loan application from that the loan officer created and analyzes that loan application for approval. Certainly construction loans have a little extra layer of complexity and a little extra layer of risk associated with them. Cost overruns aren't uncommon. Does the buyer have some sort of fallback or reserve to keep up with any potential cost overruns? During that process, also going on, there's going to be builder approval. And again, we'll kind of look into these processes in greater detail in the next few slides. Our next slide at this point, how this process looks to the realtor. From the pre-approval perspective, we kind of covered this earlier. Talk to your lender, communicate with the lender, be in touch with what's going on, because some of those details the lender may have communicated to the buyer may be lost on them. They may not recognize that certain aspects of this transaction are important, and as your advice and your professional opinion really matters to your customer in these cases. Don't be afraid to call the lender with questions. If you see something happening that you don't think sounds right, you probably want to reach the lender and just say, hey, is it okay that we're, proceeding without whatever certain details that may alarm you a little bit. Provide the contract. I can't tell you how important this one is. We as lenders can't move forward with the processing of the loan until we have the contract. If there's any inspections, soil tests, or surveys being done, certainly keep the lender informed of that, because we need to know if this contract is potentially, contingent on a soil test. Maybe we want to hold the appraisal back until that's done. And then as far as approval goes, make sure your lender's in touch on that. Make sure that you've communicated to the lender, hey, I need to be kept informed of what's going on with this file. Make sure the lender's got your contact information, and you should be in good shape. Finally, at the closing, you're probably going to get paid in full for the entire value of the transaction at the closing. This depends greatly on your agreement with the individual builder, but most builders will pay you, and you will receive a commission on both the purchase of the lot and probably, depending on how you've worked it out with the builder, a commission on the buyer that you've brought to that builder. So commissions on these can obviously be sizable, and that's a nice bonus. So of course this is a difficult, specialized process, but by the same token, hopefully you get paid for doing it. Finally, I think I'm going to run through a little bit of greater detail on processes. I've covered these for the most part, but I wanted to kind of keep everybody informed of some details on it, some common questions that I see. Number one, regarding the appraisal. It's done based on market value. So if somebody's building a 4,000 square foot home in Loveland, what the appraiser is going to do is he's going to look for other sold homes in the area, for instance, Loveland, at about 4,000 square feet. And the appraiser is going to be looking for similar homes selling, quote unquote, nearby, which generally means within a few miles. And recently is identified as preferably within the last 6 months, but up to 12 is usually okay. And that all of these things are going to depend on the area. If you're building out in, Goshen, Ohio, that radius of how close the similar properties needs to be is probably going to be wider. But in any event, you need to be a little bit careful with that. Frequently in these, we see situations where someone is overbuilding. And understand, people are absolutely free to overbuild. That is their choice, and God bless them for doing it. However, we as a lending community usually tend not to want to jump into the mess with them. So if they're going to be building above what the market would otherwise say is prudent, they need to be prepared to invest some of their own cash in that transaction. We're probably only going to be willing to lend based on market value. The other key point that we see a lot of questions about is cost approach. So are we appraising this based on cost approach? And the answer to that is simply no, we're really not. Just because you're building an $800,000 home out in Goshen does not mean that the home is going to be valued at $800,000 from our perspective as a lender. We're going to look at similar homes in the area and evaluate according to that. Moving on to the next page. Builder approval. This is a key detail that often gets overlooked and usually isn't a problem, but it's worth mentioning. The builder in the process needs to be generally approved by the lender. It does not have to be on a transaction by transaction basis, although these loans are usually looked at by somebody from that perspective on a transaction by transaction basis. But the builder will be required to submit supplier references, usually some subcontractor references. Credit is definitely checked on the builders. We check, along with that credit report, we check for any judgments or lawsuits against the builder. And usually we're looking to see that the builder's experienced, generally runs things fairly well, has minimum standards of credit, and this is really designed to protect both the bank and the buyer. We are making sure that the buyer isn't tying themselves to some builder that isn't going to be able to complete the project, and that's an important question. We as a bank certainly don't want to be stuck in the position of having a half-built house as collateral, and I'm sure your buyers don't want to be in that position either. So we're trying to protect against that with these builder approvals. Most lenders update those builder approvals every year, so that's an important factor to recognize. And again, this is just part of us as your lending institution trying to protect the consumer, ensuring that the transaction goes smoothly for all. Next slide. Underwriting. Real key points here. Underwriting on these is going to be a little bit different. Oftentimes we have people coming to us that have not sold their current home yet. We are going to factor the debt and the cost of ownership on that home into their overall approvability. So they need to be able to, according to the guidelines of the loan program, they need to be able to afford both their existing home and this new home after construction is complete. There is usually some sort of payment during the construction period, but it's a less than standard payment. Most lenders simply collect an interest-only payment on the amount of money in use during the time of construction. So a full payment is really not ever required until the home's actually complete. Credit is looked at more closely on these. So minimum credit scores for construction loans tend to be a little bit higher than what you have on a regular loan. And finally, and maybe one of the more important features of construction lending that really is seldomly discussed or covered in a conventional loan, although this concept does apply to conventional loans, is reserves. Money left over after closing. We want to see that our buyers on a construction loan have some good, solid funds in the bank after they've completed this transaction, so that in the event of a cost overrun, they're covered, that we don't have any problems cropping up as a result of, geez, the septic system cost $15,000 more than we expected. Somebody's got to come up with that money, and it's not, generally speaking, not the bank who's going to do it. These are funds that aren't borrowed. The buyer's expected to be able to come up with certain contingencies like that in the event they crop up. So reserves are very, very important on these. Reserves apply to conventional purchase money loans, but the level of reserves on a conventional purchase money is significantly less. Usually, if any, somewhere in the range of 2 months of mortgage payment, whereas on a construction loan, you're looking anywhere from 12 to 24 months of mortgage payments left over in the bank after closing. At least at our institution. Different institutions will have different rules on this. So that begins to wrap up my presentation for the day. If you guys have other questions, please feel free to pose those questions now. I'm going to check out here and see if I can see any questions that are that are up here. So far, I can't see any, and I don't know if they're just not there or not. Hold on a second while we deal with our minor technical issues. If you have questions, just use the raise your hand button over on your webinar manager, and maybe we can get to them that way. I'm not really sure. We're getting a little help here on the system.
Well, this presentation will be accessible after viewing today on our archive, which is what is the domain for that? cabr.org under /education. cabr.org/education. In fact, all of our archives, all of our webinars are archived there.
The question was, will this webinar be present after today on the website somewhere? And yes, it will. So, any other questions at this point? All right, folks. Well, I don't see anything. Okay.
Why is the reserves evaluated?
Why are reserves evaluated? Because you've got a lot more risk here. You've got the potential for cost overruns. You've got the potential for change orders. These projects have inherent risks of that nature. And because you have those inherent risks, you need to be covered from those risks. Having a little bit extra money in the bank can make some problems go away. And that's why we look at that with as much detail as we do.
Are grants offered on construction loans?
Well, yes. The question becomes, will the individual that qualifies for the grant also qualify for the construction loan? Those are two demographics that usually don't intersect. Most grants have some sort of maximum income, and most construction loans really start in the higher ends of the market. About the lowest purchase price project cost that I see on a construction loan is, I guess the lowest I can think of is about $160,000. And most of the folks that qualify to comfortably build a $160,000 home probably aren't going to qualify for the grant. So generally speaking, there's nothing that specifically excludes one from the other, but there usually aren't any issues.
Thank you. Once the construction loans are approved, what is the risk for the buyer?
Wow, that's a great question. Well, your builder can evaporate, die, go out of business. There's a long list of things that can happen there with regard to the construction moving forward. Depending on the individual loan that you've done, some lenders will allow you to lock your interest rate at the time that you start that application process. We, for instance, will allow you to do that. You can lock into a 30-year interest rate at the actual loan application, and that's going to be your rate for the remaining 30 years that you own that home. Other lenders don't necessarily allow that, and so you have to watch out for, you're doing this construction loan, and then you're going to be subject to whatever the rates are at the time that the property is completed. And if the market moves during that window of time, that's a risk that you're taking on. So that's generally a major risk.
I have a piggyback to that, Phil. What would the solution be if the home during construction was damaged by something? A forklift, a storm, a fire?
There's insurance for that.
And who covers that?
Interesting question. Usually, An insurance policy, for us as an institution, an insurance policy will be required. We aren't unique about that. Every institution is going to require some sort of construction insurance. I've seen construction insurance carried by the builder. I've seen construction insurance carried by the buyer. It's really up to the individual contract. I'm not an attorney, and therefore I can't really give legal advice as to who's responsible. Probably the guy driving the forklift. But in all reality, is there a mechanism in place to protect against that? And the simple answer to that is absolutely. Again, as the lender on the deal, we tend to be the I don't know if a voice of reason is the right word for it, but we intend to be the most conservative group in the room. So if we see a risk, we're probably going to do something to cover it, and that's certainly a risk that we recognized and covered.
So here we go. Can you use USDA underwriting guidelines to fund a
construction loan?
Yeah.
Generally speaking, I'm going to say I don't think so. I only know of one institution, and I'm not sure if I can mention Huntington's name here, but they do government loans and use in conjunction with a construction product, but I think they only do FHA. I am pretty sure they don't do VA or USDA in conjunction with construction.
So that's something you need to talk to your lender about.
It's a lender-specific question, and like I said, only one lender that I'm aware of even approaches any combination of government loan product with construction lending.
Thank you. Well, some good questions. I'm glad everyone's involved here. I think the topic was very good. And if there aren't any more questions, I'd like to thank Phil for his time today.
Glad to do it.
And thank the board and Amanda for helping us organize this, and the Realtor Committee themselves for helping come up with this topic. And so until next month, thank you.